welcome back to 2025 Kansas City Commercial Real Estate Market Pulse. We had a phenomenal 2024 in regards to the Market Pulse. We were able to have over 12 different editions, and this show is so much different than just interviewing and doing a podcast. There's a lot of work that goes into the preparation for this show, for all of the content that needs to be put together, all of the slides. And so it is a different medium than many people are used to, but the feedback that we have been receiving with the informational presentations and the data set, we're getting really great feedback on that. Now, I know if you're watching this or you're listening to this after the fact, you may need to go back and watch the YouTube show or reach out to myself or Katie on the team to be able to actually get the presentations. We make those widely available. All you have to do is sign up for our email list. But we are very excited to be back. So what is the Kansas City Commercial Real Estate Market Pulse? Well, we're aiming to be your go-to real-time data-driven insights source for Kansas City commercial real estate. Whether you're an investor, you're a broker, or you're just curious, this show is designed to help keep you ahead of the curve. So this means that we are going to be providing a lot of data. We're going to give you comprehensive views of the market, including different listings that are out there, transaction overviews, and detailed analysis of market trends. Our goal is to position ourselves as not only a trusted brokerage resource for you, but a leader in the industry in regards to the expertise. So whether you're buying, you're selling, you're leasing, or you're investing, we're striving to be the first name that comes to mind for up-to-date market information and expert guidance so we can help you remember the future. Here's their team. It's myself, Logan Freeman, the managing broker here. A lot of you, if you've done business with us or you've watched the Kansas City Market Pulse, you're familiar with Katie and Micah and Chad and Nick and Nathan, but we range anywhere from retail to industrial to land to healthcare, multifamily, everything in between. We do a lot of leases, we do investment sales, owner-occupied work, and usually we have the capacity and ability to help you in any way in regards to commercial real estate. If you want to just talk to us about how the market is doing and what we are seeing out there, we are boots on the ground on a regular basis, and our team is dedicated to delivering top-notch service and results for our clients. Without further ado, we are back. We had 12 impactful episodes in 2024, and we're kicking off the new year with our first repeat guest, Blaise with CoStar, the Director of Market Analytics. He's a returning favorite. Blaise last joined us on October 2024 on episode number 8, where he broke down the key trends shaping the Kansas City commercial real estate market. And this time, we're diving even deeper. We're revisiting 2024's biggest market trends and doing just a little bit of forecasting for what's ahead of 2025. So, Blaise, thank you so much for joining us today, man. You have been at the forefront of market analytics, and Kansas City is such a dynamic market. So we're excited to have you on today to break down what the 2024 transaction data tells us, how market fundamentals are shifting across different asset classes. That hopefully will give folks the ability to see where the opportunities are emerging for buyers, sellers, and developers. So thank you for joining us. And I don't think we need to introduce you again, but if so, here's Blaise's background and what he has done. Very well known in the industry. Thanks for being here, Blaise.
Yeah, thanks for having me again. I may have to add this to my bio now that I'm the first two-time guest of your show. So
I think you will. And I imagine it's going to be hopefully maybe even on a quarterly or bi-quarterly basis, Blaise. So thank you for being here. We're very excited. Before I thought we would get into some Kansas City numbers, I have been doing a ton of research in regards to finding out some historical context for commercial real estate transactions. And it's a cyclical industry, right? We all know that. We all understand the cyclical nature of our business. But I think understanding the history of commercial real estate transaction volumes, that the factors that are driving the forecasted rebound and where we're at in the broader real estate cycle is really essential for positioning yourself strategically in the coming year. So really quickly, Blaise, and hopefully this will be some good information for you, and maybe we can talk a little bit about this. But over the past 2 decades, commercial real estate transaction volumes have reflected the highs and lows of economic cycles. So way back in 2007, so pre-Great Recession, our volumes peaked around $571 billion. That was driven by easy access to credit and rapid asset appreciation. Fast forward to the Great Recession, 2009, volumes plummeted to $52 billion as the financial crisis, they froze credit markets and investor confidence collapsed. So 2021, fast forward, post-COVID recovery, volumes reached a record $900 billion. And that was fueled by low interest rates, government stimulus, and pent-up demand. So where does that lead us in 2023 and 2024? Well, volumes have fallen drastically from those 2021 and 2022 highs, and it hits approximately around $300 billion in 2024. And that's due to what we've all witnessed, the Federal Reserve's aggressive rate hikes and tightened lending conditions. So 2025, I've talked to a lot of people about this and forecasts. I've read a lot of different forecasts, but experts are now predicting that transaction volumes could climb back up to close to $400 billion to $450 billion in 2025, making a much needed rebound. While that's still really low compared to the record highs of 2021, it does represent a significant recovery from the recent lows. So Blaise, any thoughts or ideas that come to mind as you see kind of this snapshot over the last, 15, 16 years of commercial real estate?
Yeah, and ironically enough, that basically spans my career in this industry. So I started in January of '08, and I felt like for like 2 years, nothing positive ever happened. It just kept getting worse and worse, right? The market just really suffered, especially from
Yeah.
a transactional point of view. I mean, I'm in St. Louis. I was covering just St. Louis at the time, but there was just a lack of activity and lack of deal flow, and banks weren't lending, and they just had a lot of issues going on. But obviously the post-COVID recovery, when rates were super low, and capital's a lot easier to come by. That was, if you look back on it now, obviously hindsight's 2020, but
Mm-hmm.
it's pretty easy to see what was happening there. And as far as transaction volumes go, we've kind of looked at I was actually looking at just the number of deals, and really it looks right now like 23 was probably the trough for Kansas
Mm,
City as far as a whole year goes, and this is just number of deals among the 4 property types. So we
sure.
did see an uptick here over the last really the second half of 24 in the number of transactions. So I think we might be coming out of the lows a little bit here, and you've seen some decent sized multifamily properties trade. We just had a large industrial deal trade here in St. Louis at the end of the year. So
Yep.
I do think we're probably coming out of that trough, just because obviously at this point the Fed seems to have signaled they've stopped raising rates and they've started lowering them. So there's a fundamental shift there, but it did decrease, but can only go so low, as you saw back in in 2009, right? How much that really fell off.
Yeah, most definitely. And one interesting data source that I try to pull from, and this isn't perfect because we obviously, not every real estate brokerage in town reports, but I love to track the Kansas City Business Journal's kind of big book of lists in regards to the real estate volume. And this is really interesting. So we only have 2022's and 23's data, but our total local volume, and this is approximate because again, not everybody reports, but just keep that in mind. For 2022, we had around $9.65 billion in total transactions. And 5 of that was from sales and 3 was from leases. We had around 4,400 total transactions, a whole lot more lease transactions because they're smaller deals than the sales transactions, right? But if you fast forward to 2023, some things have really changed. And this is interesting. Our total transaction volume is down around $2 billion to $7.63 billion. But here's the interesting component. Transactions are up, and sales volume actually is lagging lease volume by over $1 billion. So we had 1,800 sales transactions in 2023, and we had 5,800 lease transactions in 2023. So really interesting, right? Because our total volume in Kansas City had a decrease of over 21%. But in that, sales volume decreased 34.6%, but lease volume increased 30% from 2022 to 2023. So I'm excited to get the 2024 information and data. But what that tells me is, yeah, capital markets had a big impact on being able to transact real estate. And here's the cool component of that: there's still demand, especially on the leasing side for Kansas City, and you're going to see that show up in 2024's numbers. But hey, let's talk through real quick several key factors that are converging, I believe, to help with this rebound here in 2025, right? We have a lot of different converging factors. And number one, I believe that is the debt maturities that are going to create some urgency. There's a lot of figures out there, but I would say approximately $600 billion in commercial real estate loans are set to mature in 2025. We have another 1.2 trillion due by 2026. So, that whole wave of maturities is going to force property owners to either refinance, restructure, or sell, right? And many of those will be non-discretionary sellers, which is creating a surge of inventory in the market. We'll see about number two here in regards to easing interest rates, but at least the Fed's not signaling that there will be increases in the federal funds rate, right? So that might create some more urgency and some more ability to bridge the buyer and seller gap, right? But there's also been a lot of pent up demand. After 2 years of muted activity, many investors have been waiting for the right moment to kind of re-enter into the marketplace. So I think Bob Knackel put it best in regards to why he believes transaction volumes are going to be higher in 2025. Here it is. Discretionary sellers. So after years of waiting for the right market conditions, these sellers will finally seize the moment. And then you have also non-discretionary sellers, which are facing challenges like cash-in refinances or untenable financial situations. So those groups have no choice but to act. And so that duality is going to make 2025 unlike any other year. And this is for New York City real estate history. And Bob has been in the business for over 40 years, has done $24 billion worth of deals. So when he says something like this, people are listening. So those are my kind of prognostications on why some of the transaction volume might increase this year. And I know that many people listening to this will definitely welcome that, Blaise.
Yeah, I think so.
So we've got a lot to cover today, Blaise. Let's get right into it, man. What's our agenda today, right? I know we've got a lot of economic updates to go through, and then we're going to
Yeah,
get through the four main food groups. But
sure.
what would you like to accomplish?
So, my idea here is just to really, give everyone a good overview of what happened in Kansas City over the past year, and go back a
Great.
little further, even on some historical charts and data points here, just so everyone can kind of see the trends. But obviously, I always like to start with an economic update. We've got a healthy labor market right now, which we'll dive into a minute, and you just kind of see what sectors are performing better than
Yep.
others. And then we'll just get into, as I call them, the main food groups, which are office, retail, industrial, and multifamily, and kind of how those are all, sort of intertwined at this point, and what we're seeing, at least on our end right now, just for a kind of a brief 2025 forecast.
Great. Fantastic. Let's get to it. Let's start with the economic update.
Yeah. So as you can see here, that blue line is Kansas City's non-farm payrolls, and obviously that's been trending significantly upwards since 2020, which was kind of a big bottom out in job growth. We all know what happened, about 5 years ago at this point.
Yeah.
But as we've had this large increase in non-farm payrolls, the labor market's also increased a little bit. So you've had a kind of a rising unemployment rate, but when you're still sub 5%, which is the long-term average here over the last 25 years or so, you've got a pretty healthy labor market, heading into the new year here, despite the fact that it's trended upward a little bit, because it really did reach a kind of a cyclical low here a couple of years ago, again, until we had some more people coming back to the labor market, which obviously, as people are employed, that increases consumer spending, and people feel a little more comfortable, whether it's going out on a vacation or doing whatever it might be, which is kind of fueled into the retail market here, which we'll touch on in a little bit.
Yeah, main trends I think that people are watching in the labor market, obviously with the new administration and their focus on immigration and deportation, that's going to be a big focus for a lot of business owners that people are going to be watching very, very closely. So Blaise and I were talking before we went live, about 2025, and I think both of ours is, prognostication is it's anybody's guess at this point because of things like the labor market, but it's at least good to see, where we are currently in Kansas City and showing kind of a robust and outlook for 2025 and looking like we have a good labor market to continue to fuel that demand and continue to attract the businesses that fuel the commercial real estate.
Yeah, absolutely. And this is just more of a breakdown here of non-farm payrolls and just annual job growth. And as you can see, clearly coming out of the pandemic, we had this huge snapback in job growth, but that's sort of steadied over the last year here. But we're on a several year streak right now where
Yeah.
annual job gains are positive. So things continue to trend upward in here, in this sense. And then if you go to the next slide here, I've got the sectors, and this data just came out yesterday, actually, ironically enough, for the month of December. But as you can see, the laggard here is the information sector, which that's a volatile, tends to be a volatile one because it's a smaller set of the employment market. But manufacturing took a dip, but I think you've read the headlines recently. Probably there's been some layoffs at some of the auto manufacturing plants in the area,
Yep.
so that's kind of the impact there. But if you go to the left here, which is the gainers, where I see a positive right now is the financial activities and BPS, which is professional and business services. Those haven't led annual job growth in a while. It's typically been leisure hospitality, which is right there. So I was a little bit concerned about this part of the market because office occupying job growth, it was trending downward here in the first half of 24, and it started to come back, which has been a positive. And then leisure and hospitality being up there as well. That really ties to the consumer spending we've had continue over the last several years here as retailers and people are traveling, so there's more employment gains there. But if you want to go to the next slide, I can break down the kind of the office changes here.
Yeah,
um,
Blaise, on these sectors, right? Like
yeah,
one thing I've been tracking a lot is, the idea that artificial intelligence is going to create more productivity in our nation and for our country, but at the same time could have kind of a negative effect in regards to actually removing jobs out of the labor market. Would that show up here in the informational side? Is that something that's showing up, or is that even respond, or is that even reflected in what you guys are tracking?
well, I mean, this is BLS data, so this rolls into the sectors that are there. But honestly, the information sector could be one or two companies shifting their employment base
Yeah,
across one market just because it is such a small subset. So um, I don't know if it's showing up yet in the numbers because I just don't know if enough companies have adopted it, and it's so hard to know who has really gone all in on
sure.
this and who hasn't at this point. But obviously, there could be a little bit of headwinds there. In that, to your point, if productivity is going to be increasing significantly, do you need six people or two people to do the
Yeah.
same set of skills or job that you're looking to get accomplished?
Well, definitely something that a lot of business owners, real estate investors are definitely keeping their eyes on for sure.
Sure. No, absolutely. And like I was saying, this again is something I see as a positive for the office market right now. Is if you look at the blue and the red lines there, those are increasing over the past year, which are financial services and BPS again. So they were kind of trending downward here over the last couple of years before 24, but that increase is positive because while the correlation is not what it was, call it pre 2020, is as companies were hiring folks, they would typically need more office space. Now that has probably gone down, that requirement, just based on whether folks are 100% remote, hybrid, or maybe back in the office 100%. So uh, at least that's an upward trend potentially for a little bit more office demand. So it's helpful in that sense that there is job growth in those industries right now.
Absolutely. All right. Well, let's get into office because this has been one that many people continue to ask me questions about, and I think is transforming within our eyes. But man, I have seen some really big headlines in New York City and
Yeah.
other major markets, if there is a big pushback. I mean, leasing agents in those markets, major markets like Miami and New York City, are absolutely crushing it right now with the demand side of things. It's been one of the most debated sectors in commercial real estate. But what's driving this rebound in absorption? Is it a flight to quality, renegotiated leases, or are people just coming back to the office?
I think it's a combination of everything. As you know, office space is nuanced, and every tenant's a little bit different. Everyone's got their own requirements and what they're looking to do. So
Hmm.
and their own future plans for hiring. So it could be expansionary in that sense. But as you can see, we had a huge uptick and this is rolling 12 quarter or 12-month absorption, obviously. But the huge uptick pre 2020, and then this large downturn, and then we've kind of slowly come off of that at end of 24, and we finally got positive here for the first time in a couple of years, heading into the final or as of the final quarter of 2024. So,
A
I
couple of
do
years,
believe
that looks like to me that it's been 5 years, right? I mean, or 4 years,
there's a
yeah.
small uptick in 22, but yeah, you're
Ah,
right.
I see it,
It's
yeah.
been very yeah. It's been pretty rough, obviously. And to your question about what you're asking, I think it's a combination of a little bit of everything. And I've got some kind of more slides that go into that, but I think you've had a slowdown in move outs where you're not seeing companies put on 200,000 square feet of sublet space or even 50,000. That's becoming less common because I think at this
Yeah,
point we're 5 years past everything, and when a lot of space requirements were unknown, and there's a little bit more certainty now, I think, in the way companies are operating. So that's kind of given back that, or it slowed down those move outs. And I would agree with you. I think there's been a good push towards nicer, higher end properties as folks have maybe consolidated their office space. They can maybe reduce their footprint by 25 or 30%, so that allows them to maybe pay a little bit more in rent and get a newer building that might be, either recently upgraded or recently built at this point. So there's kind of just a mix of all of that. And
yeah,
I know obviously the return to work mandates by large corporations make some headlines, but I feel like I'm seeing it more in St. Louis, at least with just traffic flows driving to and from the office. I think
sure.
that's a very obvious indicator. Additionally, parking lots seem to be a little more full when I'm driving around. So yeah, I think it's a combination of a lot of different things right now it's causing a little bit more of an uptick than the kind of the huge downturn we'd seen in the previous couple of years.
Well, anything positive in that sector is fantastic, but, this also showed me that, the supply glut seems to have stabilized, right? And,
Yeah.
I'm trying to figure out, or is the office market at the bottom, or is there another wave of lease expirations that could impact this trend? I mean, it's been slow to recover in many markets post-pandemic, but, you just showed us and we just showed the audience here that, it looks like positive net absorption is back here to stay, hopefully.
Yeah, and again, this trend, so you see these little blips, but obviously, these little drops and increases. But we're on a couple quarters now in a row here where the
Mhm.
amount of available space on the market has declined, and a big reason for that, really, excuse me, is the kind of the reduction in sublet space that has either been burning off or leased, or some companies maybe even taking it off the market because they decided maybe they want the space. And again, office is so nuanced, and there's so many different opinions by different companies right now, but it seems like just that lack of uncertainty now is kind of helping kind of stabilize things a little bit, especially at the top end.
Yeah, I mean, this was really telling. I mean, we've heard a lot about companies, dumping excess space on the sublease market in the past couple of years, but,
Yeah.
what do you make of this decline here? I mean, is this a sign that kind of tenants are taking back control of their footprint?
Yeah, and also, you have to figure too, there's a little bit of what I would call burn off, right?
Mm,
As someone in 2022 may have listed space for sublet that expired in early 24. So
sure.
that goes from a sublet space to a direct space. So that's now, the landlord trying to lease it. But, there's certainly been a downturn here, and when we're getting close to that long-term average, but obviously has been brought up by the last couple of years. But it's more of a normalization of that market relative to what it was back in 22 and 23, when it was around 2 million square feet.
Yeah, no, absolutely. And the trend that I kind of just mentioned in some of the more major markets, I mean, leasing activity is starting to rebound here. So that's another positive sign.
Yeah, and this goes in. Obviously, you've got trailing 4 quarter leasing activity here, and we're just slightly above the average over the last 10 years or so over the last few quarters. So, and you can see the kind of how everything fell off in 21 and 22, and it rolled along, and it started to tick up again here in 24. And this includes new leases only, so this doesn't count for renewals, which
Okay.
are, I think, still a big chunk of the market, obviously, because if I'm in 10,000 square feet, I need 10,000. I'm just going to, maybe stay in the space as is. So it definitely good sign to see an increase in new leasing activity here.
Yeah, no, no, most definitely. Okay, our favorite part to get into. Let's take a look into the future.
Yeah.
And
So right now, as we're sitting here today, and we update our forecast quarterly. So this was recently updated. We're seeing a positive upward trend here. With supply and demand kind of matching each other in 25. I think a lot of that absorption will be supply driven, just because of some buildings delivering with occupancy. So,
sure.
right now, the way we're targeting it, we should see the most absorption we've had in about 5 or 6 years here, going back to
Wow.
2018, and maybe a slight improvement in the vacancy rate of the general office market. But just based on this chart here, as you can see, we're well above where we were heading into 2020 still, when it comes from a vacancy perspective. So there's still a lot of buildings out there with a lot of space, but at least again, as we've kind of reiterated here, the trend is turning a little bit to the positive.
Yeah. Well, that's good news for the office market, not only nationally but here in Kansas City. We are starting to see it. So I appreciate that update, and hopefully these trends continue. And I think that they most likely will. So moving on to one of my favorite asset classes to talk about is retail. It's been surprising a lot of people with its resiliency. And I'm just curious to kind of see and walk through what's driving that tightening of fundamentals.
Yeah, so retail, if you look back, retail's kind of been underinvested in since
Yeah.
about 2008 to 2010, when obviously the great financial crisis, spending fell off, and there's a lot of retailers that had overexpanded and kind of got caught with a lot of stores that were underperforming. Um, so became this kind of underinvested asset class, and coupled with the rise in consumer spending we've seen since 2020, that has really tightened conditions, because
Yeah.
construction really has not recovered to what it was. You're It's not as common to see a large power center get built as much as you were maybe 15 years ago. So huge uptick in consumer sentiment and consumer spending has really driven this. And obviously, you know uh, post pandemic stimulus packages and things like that put a lot of cash in people's hands, and it's caused a huge tightening of the market, just in general. And right now our vacancy rates are the lowest we've had on record in our data right now.
Wow. Yeah. And I just sort of wonder if developers are going to be pouring more into this asset class over the next year. So maybe we could talk a little bit about some construction starts here soon. But yeah,
Yeah.
this is another really interesting trend, right? I mean, we saw a lot of shakeout of retailers during, post COVID, and most of those are in large scale power centers, right?
Yeah.
But like, does this suggest that we're, maybe past the worst of that phase?
Yeah, and the move outs are down so much from what they were back in 2021. So there's less retailers vacating space now. That being said, I think we're probably going to see an uptick in general move outs here over the next couple quarters, at least in the first half of 25 is what we're looking at, because of the
Mm,
fact that you've had a lot of large Party City, Big Lots,
big
Walgreens
lots, yeah.
announced closures, right? And so the way it comes down with closures is, closures usually when they're announced are pretty quick. They happen within maybe 60 to 90 days or even less. Whereas, for example, Aldi is opening 200 stores. That could take
Right.
3 years to happen. So, the move outs are probably going to trend upward here a little bit over the next couple quarters, just due to the fact that what we're seeing, what's been announced. But as we've seen in our data, a lot of these large users that are going under, their spaces are backfilled pretty quickly. And I'm
Mhm.
sure you've seen it as well, from personal experience. And there's a lot of demand for those spaces. I was talking to our national retail director, who sits next to me in our office here, and he's landlords are looking out several years now at spaces coming available, because they just
Wow.
don't have anything on the market for 2025 right now. So
Yeah, it's definitely an interesting trend to continue to to watch. And I've been so surprised, when either Big Lots or Party City, is saying, hey, we're shutting down stores, the demand for that. But, you got to think these folks in those businesses, they knew what they were doing in regards to where the locations were. And I know since 2008, we have been not delivering the space in this sector. So it makes a lot of sense when you keep it from that perspective. But man, it's been very surprising to kind of see the demand for those big spaces as they come online. And I mean, it's great for the business, and I'm just kind of curious to watch, if they're going to be repurposed and how they're going to be used. But it goes back to, location in real estate.
Yep, absolutely.
It seems like small format retail is outperforming. I'm trying to, and I got my own, theories around this, but why is that? Do you think it's more about, neighborhood retail demand or investor preference, or something else driving these fundamentals where the smaller properties are seeing the lowest of the low vacancy rates?
Yeah, a lot of that, is I think could be tied to the call it the quick service restaurant model that
Okay.
has been, becoming more and more popular especially over the last 4 to 5 years. You've had a lot of large scale expansions by, whether it's Whataburger or Scooter's Coffee or tenants like that, and those tenants, you can obviously based on the availability rate, there's not many options for them. So a lot of them, that's where the construction has been, is those smaller, you drive around, you can see these. I see outlots all the time that I feel like have been sitting for 10 plus years that are finally
Right.
getting developed now, right? And a lot of those users are changing their model where it is drive through or mobile ordering only, and so there's no dining inside. So to accommodate that, they're
Mhm.
building new, and in addition to the lack of available space that's there. um, but yeah, it just seems to me that is, you think of smaller fitness centers, smaller restaurants, and those types of users that are out there. um, Nail salons, things like that, things that where people have to be there, and there's actually a demand for it. So
Yeah. I have been watching Scooters and Seven Brew and all of these concepts be developed. And, it sort of feels a little bubbly to me, and, making sure, but, the sales per square foot are really good on those stores. Right. And the cost to build them are a lot lower than, building a bigger building. So we'll see if that continues to go, but it doesn't look like, Scooters or Seven Brew or any of those other types of concepts have any indication that they're slowing down. So I'm watching them pop up all over the place. Yeah,
and they go fast too. They
they
they,
do.
they come up real quick. Um, and so I just wanted to address this was, just more of a, talking about a tightness in the market, as you were saying. A lot of these locations are, that of companies closing down are well located, but additionally, there is kind of a lack of newer high-end space that's out there as well. So, you're looking at more than half of the available retail space in Kansas City was built before 1990, and 45% of it before 1980. So, think even tighter if you need a newer building or a newer center that you want some more modern amenities. Your piece of the pie is even smaller as to what options you have. So, I think again that's probably another reason we've seen a lot of these users build their own facilities, just because
Yeah.
it's easier for them to do that than find something available.
Yeah. In my experience, a lot of this is large shopping centers, 50, 150,000 square feet that are
Yep.
just in areas that are unleasable, frankly, either, I'm not going to say they're obsolete, but the demand for the location where they are and the vintage that they are just does not attract the tenants that they need for that to be successful. But this makes a lot of sense in practicality as I was thinking about, this, because I think there's some areas of town that have older properties. Maybe new population growth in those areas is not as strong. There could be even a migration out of those areas to different locations, and that causing a lot of this. But 45% was, a large amount of this marketplace, which, kind of presents an opportunity, I think, for, potentially, some investors to come in and modernize something similar to what we've been seeing on the industrial side that we'll see here soon. Is you got an older property. The tenants and the businesses that want to be in that may need some automation. They may need some upgrades and some focus on the tenant improvements. That could be an opportunity, but again, they still have to be well located, as we both know.
Yep. Sure. Yeah, and I just want to touch on the strength of Kansas City's retail market right now. So this is all markets that we track in CoStar over 100 million square feet of inventory, and as you can see, Kansas City is number six or seven there in rent growth over the past year. Yeah, and obviously, as you can look at this, there's a lot of large markets that are growing significantly when it comes to population. You think, Jacksonville, Phoenix,
Yeah.
Las Vegas, areas like that, Dallas. So, Kansas City's is doing really well here, kind of punching above its weight as far as size of market. But I just thought this was a good comparison to look at, what's going on across the country here as far as we're seeing in retail rent growth right now.
Well, this may segment the viewership here, but being a Kansas City Chiefs fan, I love to see that Kansas City is definitely out punching Philadelphia here by over 3.4% in regards to our retail market. So head to head, commercial real estate. Let's do this for the Super Bowl, right? So we're
Yeah,
we're winning in that regard.
my son went to school in his Mahomes jersey today, so we
There
got,
we
we got
go.
that we got that going.
I love to
Uh,
hear it.
Yeah, and so as I kind of touched on earlier, just our kind of brief 2025 forecast. We're right now as we're seeing it, we're kind of forecasting a little bit negative demand on the absorption front, and again, largely due to what I mentioned earlier. These larger large operators that have filed bankruptcy or are closing, announcing store closures. So I wouldn't call this softness, just more of a kind of a just situation right now we're seeing with a lot of these companies, shuttering operations because I think right now in the annual data, move out or not or closures were about double what they were in 2023's pace at least on a national level. So that's kind of the reason for the softness right now.
Yeah, that makes a lot of sense. And obviously the delivery still being extremely low compared to, let's go back even to 2015, 2017.
Yeah.
That's a substantially lower amount. So I mean, if the space was available in the right locations, maybe this looks a little bit different. So again, if you are an investor developer, we're spotting some trends and some opportunities here.
Yeah, and I think you'll see some of those locations get taken pretty quickly. I think there was one in Kansas City. It was a Walgreens that is becoming an Ace Hardware.
Yeah.
Yeah, which not saying I have a crystal ball, but that was one I just did not see coming. So that there's an these companies will adapt, I think, and find uses for what's out there.
Well, excellent. Very good overview of the retail market. Let's get into, industrial real estate, which has been the golden child of commercial real estate for quite some time now. But, I think we're seeing some shifts in fundamentals. Demand seemingly is still remaining strong. The vacancy has been, ticking up, which will showcase. And some markets are seeing some rent growth really kind of slow. But
Yeah,
let's just kind of dive into kind of where Kansas City is in regards to, the industrial side of things. Let me get the slides right here. There
yeah,
we
you're
go.
you're good. Yeah, obviously, COVID 21 and 22 were just huge years for demand, and
Yeah.
a lot of markets saw this. Kansas City was not unique in this sense, but yeah, and is a part of that. When we were talking about earlier, when it came to transaction volumes, lower interest rates, it made it a little bit easier to develop sites, and you had a lot of demand. So with that came a lot of new construction,
Yeah.
and so as demand has slowed a little bit, we've seen this uptick in vacancies. Now, Kansas City is still kind of outperforming the nation if you want to look at just the general vacancy rate. But the last couple of years have been a slowdown. Going into the pandemic, 2015 to 19, we had about 5 million square feet a year of absorption,
Hmm.
and that went to 11 million a year in 2000 to 2020 to 22, and now we're at about 4 million. So we're
Yeah.
we're kind of back to that pre-pandemic number, which is still not, it's not struggling, but when coupled with the high amount of demand that the market's seen over the last few years, you're going to see an uptick in its vacancy rate. So
Yeah. Yeah. No, that makes sense. And breaking that down to logistics properties, that looks a little bit different here.
yeah, and logistics are a little bit more because that's primarily what's been built over the last couple of years here. It's about 75% of the market's inventory, give or take. And said, while again, it looks like Kansas City might be underperforming here. If you were to look at absorption as a percent of inventory, which just give it a percentage rate, that kind of balances things out. On a national level, it's about in 2024 it was like 0.5%, but in
Mm,
Kansas City it was around 1.1. So
okay.
that put Kansas City in like the top quarter of the nation of the kind of national index that we track. So, um, again, it looks like it's lagging, but again, if you want to break it down by the size of the market, it's about double what the national average was um, in the past year.
Yeah, and for those that maybe don't know exactly what a logistic property is, how are you guys classifying that?
So that would be just warehouses and distribution buildings.
Okay.
If
Yeah.
you're to look at our properties, and then you have like manufacturing would be considered manufacturing data centers, things like that would be in the kind of a specialized category, and then you've also got the flex categories as part of that.
Got it. Makes sense. All right. Availabilities are up in the larger properties. That's
Yeah,
I mean, not a
yeah, and so
surprise for me, but let's talk
well,
through it.
yeah, this is this is what has been getting built over the last couple of years.
Yeah.
And again, you've kind of seen a leveling off, which is a positive because you're seeing less speculative development. A lot of what you're having built over or at least what you're seeing announced as far as construction goes, is our build to suit projects. You've got I believe it was Amazon just announced the 600,000 square foot building up by the airport. It hunts Park up KCI 29, I believe,
Yep.
which is where I think Ace Hardware's 1.5 million square foot building is getting built. So there's development still happening, but it's on the build to suit front. But this large spike was primarily due to the spec construction that happened. But again, yeah, you talk about where Kansas City is. You're right around 9%. Call it. Memphis is in 15% range. Indianapolis is around 17, 18% for similar sized properties. So
Mhm.
it's not as though while things are up, it's not as though there's been a huge uptick. So same goes for the next size down, which like the 250 to 500. Places like Columbus and Dallas were over 10% the last time I looked at this. So again, seems like things are weakening, but when you put it into perspective, it's still doing relatively well as a whole.
Yeah, most definitely. Okay. Well, what changed in the second half of last year to cause, this leasing surge that we've been seeing?
Yeah, and so we were actually just talking about this. On a national level, it seemed like there was been a decent uptick on an annual basis in the fourth quarter, and I don't know if a little bit of that may have been a little bit more certainty surrounding election results in
Yeah,
November potentially, but you could only go up from where we were is if you look at the kind of the second quarter of 24
sure.
there, which was a multi-year low for leases getting signed. Even across Kansas City, I think we had about half the number of 500,000 square foot leases signed in 24 relative to 23. So less large users out there, but at the same time, there's been kind of an uptick in that 1 to 300,000 square foot range. That's kind of driven that back to where it was in 23. So
Yeah, no, that makes sense. We've kind of already touched on this, but it looks like that build to suit projects are really what's keeping Kansas City construction pipeline elevated. So, I mean, while when you look at a national level, yeah, we've got a lot of supply that could be coming online, here with it being under construction. Lots of those already have their tenants lined up.
Correct. Yeah, and you look at like Panasonic, for example. That's a big chunk of it. You've got for, Walmart's beef processing facility that's under construction. I mentioned Ace Hardware. That's another
Yeah.
one. So a lot of these are coming with tenants in hand as they're getting built here over the next couple quarters and opening. So there's obviously been a big drop in construction across the country, just given the current lending environment and interest rate environment. So a lot of these markets are down like about over 50% from what they were, a couple of years ago at the peak.
Well, I'm looking at this, and Kansas City, we are 2 for 2 against the Philadelphia market here. So, in regards to the pipeline that's coming online and under construction, we are again ahead of Philadelphia. So, I'm liking our odds here, Blaze.
That's good. If you want to go straight on fundamentals, that helps.
Yeah,
um,
this is where things get interesting to me, right? I mean, Kansas City has seen a surge in industrial development, and we have some of the biggest players in the country here, right? We got North
yeah.
Point, we got Van Trust, we got Hunt Midwest, but I mean, I think that has something to do, with the construction starts. But I mean, let's dive into this and see what kind of trends we can think of.
Yeah, I mean, we're kind of back to where we were, call it pre 2020 right now, as far as
Okay.
construction starts go. Again, which is not surprising given what's been going on, and then with the capital markets world right now.
Yeah.
You've also had less spec development, so I think you've got a lot of sites that are ready to go potentially. It's just a matter of developers, I think, being a little more disciplined when it comes to going ahead with a site and maybe trying to land a tenant first, which,
Hmm.
given a bit of slowdown in demand, I think I can certainly understand. So, but like I said, this elevated pipeline is, a lot of it is tied up into some major projects right now that obviously are going to, benefit the region as a whole with job growth and, things of that nature. Primarily, you look at Panasonic, and then you've got, was it Accelerate? I think just opened their facility, which is about 400,000 square feet to accommodate, the demand they're seeing from data center development. So,
Yep.
um, definitely some winners out there when it comes to, trying to move forward with some of this development.
Yeah, most definitely. Well, logistic rents seemingly are remaining strong. So, I mean,
Yeah.
even with, given we've got rising costs, but I mean, I'm just curious to see, or hear from you, I mean, this Kansas City has some of the most unique demand drivers, I think, to help keep the market stable. But what's happening with lease rates right now?
Yeah, and I think we've been on this run, obviously, that was, you look at before pre 2020, 4% was your norm, and that
Yeah.
really increased by almost double. In other markets, especially larger Sunbelt markets in particular, saw even higher rent growth. But I think Kansas City having a little bit more, like I said, a disciplined approach when it comes to development here. The pipeline kind of just started to slow a little bit quicker, so that's kind of helped rents, you know, rent growth stay a little bit higher as your
Mm.
your vacancies haven't gotten as high as some other, other parts of the country at this point in time. So, um, just kind of a kind of a nod to the, I guess, the benefit of not getting overdeveloped too much,
Yeah.
like
Yeah.
we've seen in
No.
some other parts of the country.
Yeah.
Um, and then forecasting, obviously we're here right now, but we're seeing a little bit more of a balanced market in 25, with as the pipeline slows a little bit, and you've got some development occurring that is going to finish delivered, so that will be directly related to absorption. So that kind of takes our vacancy rate up a little bit over 6%, but still pretty healthy relative to, what's going on across the country right now. Still a decent spread. I think last I looked, Casey was about 100 basis points below the national average when it came to overall vacancy rate. So
Yeah. Well, I had a conversation with an investor because we do have some assets here in the industrial side, and he was just asking me about, like, this report that came out, and it looked like Kansas City had maintained one of the best vacancy rates in the nation, which is obviously a strong indicator of continued demand. He was very concerned about the new inventory coming online. I think it was about 6 to 10 million square feet. I can't remember exactly what it was under construction. I'm sure we have it here, but it was about 3.9% of the existing stock, with
yep.
another, with a total of, I think, 14.6% of the stock either under construction or planned. But I walked them through, kind of the information around, like, yes, we have some of the biggest developers here on that side, but they are being way more conservative in regards to developing that spec product type. So it's not that this space is going to come online, and tenants may have more options to choose from. Those buildings are coming online with a tenant ready to go, and that kind of eased his concerns.
Yeah, I think the availability rate is of properties under construction over, I think, like 100,000 square feet is around 20%, which
Okay.
is well below what the national average is at this
Yeah.
point. So it's definitely much. You got to got to pull behind the curtain of Oz there and look at it,
Yeah, most
see what
most
see what's
definitely,
there.
and that's just reading a report, from a group, is not going to tell you everything unless you have that context. So thanks for bringing it to us here on the industrial side.
Sure.
Moving on to the multifamily sector, a lot of people's favorites. I'm curious to hear, how is the apartment market holding up in Kansas City? Talk to me about this net absorption. Look at this.
Yeah. We Kansas City saw a huge, and nationally we've seen an uptick in demand as well. So there's
Yeah.
been a trend there, but relative to 2023's number, our demand was up about 130%. So
Wow.
we saw demand outpace supply for the first time since 21, and obviously that absorption number, as you can see right there, is the second highest in the past decade. So
Yeah.
consumer sentiment is kind of up off its bottom, and we've had inflation slowing from its peak of around 9% in 2020, in late 22. So I think that correlated directly with kind of that slowing demand in 23, as it was just a little bit, prices were increasing. You also had high rent growth in the apartment market at the same time. So I think we've got a lot of folks coming back to the household formation, and then you've also got a combination of low housing inventory. So you've got a slowdown in, folks maybe moving from renters to owners, going forward. So that's just kind of keeping the apartment demand pretty steady here. But yeah, it was definitely a very strong year for the multifamily market here in KC.
Yes, it was. Yes, it absolutely was. Landed us on a lot of lists of best places to move to,
Yeah.
and best apartment markets. And the National Association of Realtors identified Kansas City as one of the best markets to buy a home in. So, I mean, there's a lot of things going for the Midwest here.
Yeah. And like I was saying, we saw this huge uptick in demand. And the biggest rise was kind of that mid-level. We rank our buildings, most people think ABC, we have 4 and 5 stars, the A, 3 stars, kind of like the B, and 1 and 2 star is the C. But the biggest uptick we saw was in the 3 star segment, which I think was probably that group of renters is probably a little more influenced by inflationary pressures and costs. So as that started to ease a little bit and improve, we saw a huge uptick in demand, which I think the 3 star was about 3 star rent, or not rent growth, absorption was about 500% higher in 24 compared to 23.
Wow.
So that was a pretty big uptick, um, obviously from those lows in 23.
Yeah, multifamily demand in that middle of the market seems to be extremely, extremely strong. So that showcases that really well. Are we still seeing strong developer appetite for new multifamily projects, or capital markets kind of keeping things slowed down right now?
Yeah, obviously starts are down from the record of where they were, but we're kind of, again, like industrial, we're back to that pre-pandemic average. And you continue to see it in the headlines in KC. It seems like there's new apartment projects moving forward here at a pretty decent pace. So you've got obviously a slowing construction pipeline, but you've also got this demand factor here that has been pretty strong, and you've
Yeah.
got population growth that has outpaced the national average over the last 7-8 years. So, um, as far as demand drivers go for that multifamily market, you've got a lot of things kind of going in the favor of the market here. So, what 25 brings for construction starts is anyone's guess, but I think what it seems like is there's a lot of development sites that could be ready to go. They just maybe haven't kicked off yet. So, if conditions continue to improve, you may see those move forward just because the fundamentals dictate that they should.
Yeah, well, vacancy rates have been a hot topic nationally, with a lot of different oversupply concerns in some metros. But,
Yeah.
Kansas City's traditionally had a pretty strong demand supply balance. So, what are the numbers telling us here about where vacancies are heading?
Yeah, KC's kind of in the middle of the road right now when it
Yeah,
comes to vacancy rates, and I've got some good national comparisons here because it's just good to see where the market kind of stacks up to everything. But you've got markets that have seen a ton of development. Jacksonville, Charlotte, Austin, Raleigh. Those markets where you've got vacancy rates 50% higher than what we're seeing in Kansas City here at about 8%. So I always think it's good. Are you trying to find Philadelphia on there?
yeah, I
They're
am.
they're they're better. They're right below. They're about 50 basis points better. So
Okay, all right.
that's what
They got us
we'll
on
take it as
one of the
one
graphs, one of the
one to the, we'll
charts so
see that we
far.
got a few coming up. We'll just see what the next one is here. But um yeah, again, this is, I think, a large testament to the increase in demand over the last year, obviously, and you've had a slowdown in development. So the market has not become as oversupplied as you can see just by a few of the other markets that we're looking at here that are at the top end of that.
Yeah. All right. This is a great one. I love always taking a look at, units under construction as a share of inventory. I think that, again, supply has been a huge discussion point across the country. A lot of new
Yeah.
product was started when interest rates were lower. Now it's hitting the market in a very different environment. So, what is this telling us about Kansas City as under construction starts as a share of our inventory? And do we want to beat in Philadelphia on this, or be below them?
If you're a landlord, you probably want it to be a little bit lower just because it means less competition coming. But it's not the highest, but again, it's down. It's not down from a high peak. You look at places like Miami and Charlotte and Nashville;
Yeah.
those were well over 10% for a long time there. As we're starting to see an easing in development here, but it's still pretty steady. It's not anything out of the ordinary. And again, it's more middle of the road that we're kind of tracking right now. It's not too high, but it's not too low, because I think at a
Okay.
certain point when you get really low, you're going to have some really, you're going to get to some super tight conditions here potentially if you're not developing as much. Um, on the multifamily front.
Good. Well, good to know we're kind of right where we need to be on that front.
Yeah.
Now,
So
I know Philadelphia isn't going to beat us on apartment rent growth. I know for a fact.
yeah. So all of this equates to a pretty healthy market for rent growth, and you're seeing a lot of these kind of in the Midwest.
Yeah.
You've got Detroit, Kansas City, Cleveland. Columbus is still up there, Pittsburgh. So uh, again, the markets that are at the bottom right there, you're seeing that are those that were heavily elevated with their vacancy rates and have had a lot of new developments. So the Midwest has kind of taken hold here, and the Northeast has taken hold here over the last couple of quarters when it comes to rent growth. And again, Kansas City did not reach the levels seen in those of like Austin and Nashville, but again, it's a little more disciplined, and it's kind of just plugging away now at a pretty decent clip.
Yeah, I mean, to see a market like Kansas City be in the top 5 here is for apartment rent growth is going to continue to attract a lot of developers and investors into
Yeah.
the marketplace. So, yeah, absolutely agree.
So this goes back to the demand side of it, which is just again as the share of inventory. So we're at about 3%, give or take. Again, not the top, but also not near the bottom. So you're kind of pretty balanced right now. But you have places like Austin, Raleigh, and Nashville, but even that is still not enough to keep up with what is being built right now. So
Mhm.
um, again, those Sunbelt markets that saw a lot of development are trying to keep up right now, but you've got the more steady, I'd call it, Midwestern markets that are holding on right now.
Good. Good.
Yep.
Okay.
And then we didn't. Again, I go back to the oversupply, not oversupply, but heavy supply expansion for a lot of these markets. So again, while one of the reasons we're not seeing a huge uptick in uh, vacancies, obviously, because we've had demand outpace supply, is the net deliveries were a little over 2% the last year as a percentage of inventory. But again, you look at places Austin, Nashville, Charlotte; those are well over
Yeah.
6%. So you've got a lot to compete with there if you're a owner of an asset in those markets trying to get at least as these properties are being built. So
Yeah. No, that makes all the sense in the world to me.
yeah. And then again, you talked about this, like what's coming on the line, coming down the line here for the market. So right now, if you were to level this out, we're, Kansas City's near the bottom third here of this list of markets when it comes to
Yeah.
what's under construction as share of inventory. So that oversupply risk is a little bit less than you'd see in some of these other parts of the country here. So
Yeah.
hopefully that's a good overall comparison just on the national picture for what's happening across Kansas City compared to the rest of the country.
Yeah, it absolutely is. And, a lot of people continue to ask me, man, who continues to move into all these apartment units that are being built in Kansas City? And I always have to try to just go back and say, hey, can you just go watch our Kansas City market pulse? Because, we absorbing all of these units and then some. And here is why. But the data is not lying, but it just, when you see it on a regular basis and you drive by it, it's hard to think about, 300 people moving to that spot. But when you look at the population growth, you see what is happening on the single family home side. That supply demand obviously starts to make a lot more sense for folks. And but it can be tough as they're just driving around looking at all these new projects in specific areas, which we will talk about right here.
Yeah.
Exactly what we want to get to is what submarkets are dominating this.
Yeah, so as you can see, Johnson County's at the top as far as absorption goes over the
Yeah.
and this is just the top 10 largest areas. But Johnson County, at least in our data, is about a third of the apartments in Kansas City. So not surprising that it's near the top there. But it also has one of the lowest vacancy rates among
Yep.
those markets, if not the lowest right now for development. And then you've got a lot of new demand in Northland, which is obviously primarily a lot of that is right across the river north of downtown there. But you've had a pretty good amount of your demand in really two areas here over the last year, three if you want to get into Jackson County a little bit. But just to kind of give viewers an idea here of where the demand is broken out at. And again, it primarily in Johnson County, which is fundamentals there continue to be pretty strong relative to the rest of the market.
Yeah. That's a great breakdown. I loved seeing that.
Yeah. And then, what we're looking at here, I try to break this down by property type, by star rating. And as you can see, we're predicting, the higher end market, 4 and 5 stars should see conditions improve here over the next year. And then kind of similar conditions in the other two, just as we finish out 2025, seeing a little bit more, call it more balanced here in the year ahead.
Okay. Yeah. Rent growth for our forecast.
Yeah. So as we've got, kind of, call it lowering supply pressures, we're right now forecasting, increased rental rate, rent growth projections right now into 2025, kind of back to where they were, at the tail end of the boom here in 22 and 23.
Yeah, well, that's positive on a lot of different notes. I mean, we have covered the four main food groups. We've covered a lot: rent growth, vacancy, new supply, investment trends, financing. Blaise, you have a few minutes. So if you want to go check out and connect with Blaise, here's his contact information. Definitely go connect. I know we got some questions here, but we're at the top of the hour. So do you have a few minutes for a few questions?
Sure. Yeah.
Okay. Yeah. So one that came through, what's a contrarian take that you have on Kansas City and St. Louis that maybe others don't agree with?
Oh gosh. Um, I'd have to think about that. I don't know. It depends. The funny thing is, I feel like the Midwest has been getting a lot of positive love lately from national reports when it comes to what's out there. I think there's a lot of potential in both markets, just to things you've mentioned. Cost of living. You know, affordability is a big deal right now, especially in a lot of
Sure.
markets. So I don't know if that's necessarily contrarian, because I feel like it was contrarian like a year or two ago.
Yeah.
But these markets have sort of picked back up here over the last year, as I think interest has changed a little bit. So
Yep.
um, yeah, I don't know.
Well,
It's
we'll
not
let you
weather
think
related,
about that
because the
one.
weather's been crazy lately. It's just been a
Yeah. Another one that came through is, what's a major trend that people in the industry aren't paying enough attention to? Like what's the data telling you that maybe people need to kind of say, hey, you need to be checking this out?
I think the performance of higher end office buildings
Mm,
is I think there's a, call it a, I don't know, herd mentality is the wrong word, but I think people want to be in nicer high end buildings, and really consolidate into areas where there's activity and things like that. Um, I also think there is a lot of potential for what could become of office buildings that may no longer be office buildings.
yeah. Yeah.
And
That's
I think
definitely
there's
something I'm
more,
interested in.
and I think that personally just goes beyond converting them to apartments.
Yeah.
You just got to be,
Okay.
I think you have to be
Well,
creative. That's
some
my,
of the some of the key themes and takeaways, for me is that office is stabilizing, but the recovery remains fragile, and we have to keep our finger on the pulse there. Focus on a flight to quality. Retail is outperforming expectations, and small formats and service retail is driving the demand. Industrial remains strong, and those seemingly supply risks that people are seeing, we have to really understand that most of those are built to suit, not speculative building. And leasing activity rebounded in late 2024. Multifamily demand is solid, especially for mid-tier units. If you're not in Kansas City, you may watch it for potential oversupply risks, but nothing that we're seeing here is flaring and glaring to say, man, we have a lot of units under construction. We actually have a more, demand outpaced supply last year for the first time, I think you said, since 2021.
yep.
And if you go back from that, it was probably a lot longer. So investors, I think you should continue to track employment growth and absorption, and those indicators are going to dictate the next phase of Kansas City's commercial real estate market. So great job, Blaise. That was awesome, man. This is fresh data that is off the presses that I was excited to go through with you today.
Yeah. Thank you. Appreciate it.
Yeah, most definitely. A couple slides here just on some upcoming events that we've got. Thursday, March 6th, come see us at MSI Kansas City over in Lenexa. We'll be at the Contractors, Closers, and Connections event, and I will be on a panel talking about Kansas City real estate, and that panel is going to be moderated by the Vice President of Real Estate from Port Kansas City, Joe Perry, and I'm going to be joined with some incredible folks, Nicole Yates and Sean Randall Thompson, in regards to talking about Kansas City commercial real estate. So please do come and check that event out. Should be a great one. If we can help you in any way in regards to Kansas City commercial real estate, please do reach out to us. Here's all of our contact information. Feel free to get in touch via our websites or find me on LinkedIn. This has been a wonderful kickstart to 2025's Market Pulse. Very data heavy, very data rich, which really suits my liking because it helps us make informed decisions and remember the future. So thank you for tuning in. I'll see you in 2 weeks. Thanks, Blaise.
Thanks, Logan. Bye.